The industry, it's really felt the pain of cheap index funds that have gotten a lot of these assets for some time now. But now we're starting to see these big titans, these veterans who survived multiple business cycles, start to throw in the towel. And Jeffrey Vinik is legendary in the investment community. And during his 4 years at Fidelity's flagship Magellan fund, he managed to beat the S&P 500 by a fair margin, though he did receive some scrutiny during the time. He moved into bonds away from tech stocks, which meant he underperformed his peers, but that was a prescient move, setting Magellan up to completely or nearly avoid the tech bubble and capture that record rally in bond markets. And just to give you an idea of how much his skill was valued, he raised $800 million after 1996 to open a new fund, which was a record startup at that time. But really, since 96, we've come a really far way. It's a different world. And around the globe, we're seeing customers pulling back from hedge funds after poor performance that failed to justify their relatively high costs. And so you can see here that we've seen some less launches, increasing closures on the bottom here, and investors have yanked $56 billion this year. That's 50% more than all of 2018, according to data provider eVestment. So now there are these cheap index funds, and they capture nearly every style you could possibly think of, making it really difficult for these managers, and especially equity managers, to justify when they historically can't beat the benchmark. And not even Vinik, this legendary manager, has been immune. In his fund, he uses fashion bottom-up stock picking, and in a letter to investors recently, he said it's become much harder to raise money over the last several months than he anticipated. He also says he very much so doubts that he'll go back into the hedge fund business.